Hey guys, thanks for taking a few minutes to watch this. I spend a lot of my time talking to founders who are having difficulty raising money. What strikes me from the hundreds of conversations I've had on the topic is that many founders don't really understand the fairly standard process of raising a pre-seed or a seed round. One note, some of the details of this talk are focused on Northeast Ohio startups, but the process applies to almost any startup founder no matter where you are. First off, why should anyone listen to anything I have to say? Number one, I tell it like it is. I'm not here to sell you on some magical bullshit trick or make you feel better about your failure to raise a round. Number two, I've either raised or helped raise more than 15 rounds of various sizes and have multiple exits with a few failures along the way. Number three, I've spent tons of time in various startup scenes ranging from New York to the Bay Area, to Denver, Boulder, to Austin, to Chicago, and even some time in Scotland. Number four, I've dedicated the last 3 years of my life with 100% volunteer efforts to help startup founders. I don't get paid to do this, I just want to help. No matter where your company is located, there are generally 6 steps to successfully raising a seed round. I 100% promise that this process is similar no matter where you are, or what industry you're in, or how savvy you are at fundraising. Let's walk through these steps together. But first, a disclaimer. Every startup is different. You might be able to raise money without following any of this advice, or even following it, you might still not be able to raise at all. Your valuations might differ wildly. Your results might vary greatly. These are rules of thumb, not rules. So, step 1, be fundable. What the fuck does that mean? First, it means that your company needs to have an opportunity to grow to $100 million or more in annual revenue. The old rule of thumb is that investors want a 10x return, but the reality is many only invest in companies where there is a possibility for a 100x return. That means you need to have a massive market opportunity. I mean billions of dollars annual market size and probably growing fast. Your team should be uniquely qualified to address the market and be deeply knowledgeable about it. If you're a software company, your team should contain all the primary functions necessary, being a technical person, a product or design person, and a sales or business person. Most investors don't like one-person teams, so having at least 2 is really highly suggested. Outsourcing an aspect of these 3 might be necessary to achieve an MVP and initial traction, but you must have internal capacity for all the major functions to be fundable. Have an ask that is reasonable and in line with market comparables. A pre-revenue company that hasn't released an MVP and is using outsourced developer labor should not be asking for millions of dollars on a $10 million pre. And finally, you really should have some traction and growth before you can expect to close a funding round of any size. If you're more focused on eyeballs and engagement, you should have a good start on numbers of users, plus a great growth rate and a low-cost means of acquisition. Preferably growth through word of mouth, virally. If you're a product that charges money, you should have some revenue in place, and many investors agree that a 3x annual growth rate, or roughly 11% month-on-month growth, is an indicator of early product market fit. Next, you have to be prepared to run a process, meaning you need a methodical way to reach out to potential investors. This needs to be done in a CRM or spreadsheet so that you can keep track of who you talked to, when, and what was said. You should target the prospective investors by their historical deals done. Look for ones that have written checks comparably sized to what you're asking and have made investments in your space. Source lists from Crunchbase and AngelList, PitchBook, as well as your network. Find an intro and leverage network if you can, or very targeted cold emails can work if done properly. So, what is it that you're tracking and sending? A short introduction email is the place to start. It should be short, with a written elevator pitch about your company, links to a live demonstration or trial, a send-ahead deck, and an ask for a meeting or next steps. Again, short and to the point. preferably as a response to an intro from a mutual third party. Once you start reaching out and getting meetings, you need to understand the procedure that each prospective investor follows. Individual angels might make decisions quickly, but groups and institutional investors take time. Think of fundraising just like a special version of your sales and marketing funnel. Intros and pitches to prospective investors go in, and hopefully investments come out. Generally, most investors will follow a process similar to this one. Introductions from a trusted third party lead to first meetings with pitches and demonstrations. Then, if interested, the associate or partner that you met with will circle your opportunity with the partners or the deal flow committee. If they decide to move forward, you'll have a period of analysis and vetting that will result in a decision, either a pass, a term sheet, a not now, or just plain old being ghosted. Note that the analysis and vetting that we just talked about is not due diligence. That comes after the term sheet. Acknowledging that these steps are pretty nebulous, these conversion rates are close to what many experience as an average for each stage. Meaning that out of 250 introductions, you should expect the possibility that maybe only one investor will be willing to move forward and lead your round. The other investors that told you to find a lead now have a hard decision to make based on the terms set by the lead investor. Yes, this is painful math. Many of you will do better than this. Some of you will do worse. Be prepared to work your ass off to raise this money. If you live in a locale that has very few investors, I hope this makes it clear to you that you will need to get meetings with investors outside your region. Whether by phone, by Zoom, or by plane, you have to do it. When it comes to that term sheet, knowledge is power. At this point, you need a great lawyer. You don't have a choice. You must engage counsel that is experienced in dealing with fundraising and hopefully M&A for startups. They're worth every one of the thousands of pennies you pay them per hour. Please don't try to handle this on your own or use a family lawyer to help negotiate terms. It will not turn out well. Valuations are incredibly hard to justify in a reliable way. Ultimately, something is worth what someone is willing to pay for it. And that includes your startup. Understanding what market value is for your company starts with being informed. Find comparable companies on Crunchbase, AngelList, and PitchBook. Talk to your peers and mentors, and try to get unbiased input from other investors. Investors talk to each other all the time about valuations of startups that they're investing in. They don't think of that as collusion. So don't be embarrassed to share what you've seen with other founders, so that we can all experience the same benefits of being informed. Regional valuations are a real thing. Based on an analysis that I recently did, looking at 2018-2019 data from multiple sources, startups in the Midwest face significant challenges around values of their companies. That leads to more dilution at the seed stage for founders who have to give up more of their company in order to be successful bringing in capital. That in turn complicates later rounds and makes it difficult to raise more without losing your shirt. These are not hard and fast rules. If you live in a region with lower valuation averages, your best bet is to work your network, get more meetings, and don't take any wooden nickels. If a valuation being proposed doesn't feel right to you, simple, don't take it. Don't sign the term sheet. If you want more details on these averages, I'll put a link in the description for your perusal. Outside of valuation, there are tons of deal terms that you need to be familiar with. Whether structured as a debt vehicle like a convertible note or SAFE, or as an equity purchase, there is a lot to learn. Venture Deals by Brad Feld and Jason Mendelson is the definitive guide to navigating this process and these terms. Go buy it on Amazon now, I beg you. Link in the description. After the term sheet is signed, you'll be getting to the due diligence process. A key thing for you to understand is that diligence is a two-way street. Everything before the term sheet is about, does this deal make sense to do? At what terms? Diligence is about making sure that you aren't making a huge mistake. Just like the investor is going to dig into your company, you must talk to the CEOs of a potential investor's portfolio companies to make sure this relationship is a good fit. You unfortunately can't get divorced from an investor. They're on your cap sheet for life. Be prepared with all the documents that investors will want. The diligence process is still sales, but you need to be very honest about all the things you fucked up or that aren't quite right. A little embarrassment now is better than a lawsuit and a reputation hit. Now that diligence is done, you'll need to close the round. This is where having an amazing lawyer and a strong evangelist lead investor becomes vital. The paperwork associated with closing a major funding round can be overwhelming. And unless you're uber knowledgeable on the topic, paying your lawyer and their team to handle this process is 100% worth it. Use the closing documents as a tool to force the on-the-fence investors into making up their mind. Deadlines can motivate when it comes to follow-on investors. And don't celebrate anything until the wire hits your account. There are countless things that can go wrong, so vigilance is vital until the last minute. So, at the end of the day, if you're not able to raise money, there are 4 things you can do. Traction, whether it's eyeballs or revenue, solves all ills. If you're not able to get enough meetings locally, get on a plane. Make sure your messaging isn't killing your efforts. And if all else fails, maybe your ask is too high. Startup capital is not a right. It's not something you're entitled to. You have to put in the work, and it's hard. Otherwise, everyone would do it. Thanks so much for listening. And if you'd like a copy of this presentation, as well as a link to a template spreadsheet for use to keep track of your prospective investors, an example intro email, and more, make sure to follow me on Twitter at ebuholtz and to become a member of Start in Clee. A membership is just $100 a year, and you'll get access to a growing list of great resources like the contact data for 3,000 Bay Area investors, or a list of 500 journalists, reporters, and bloggers that might be interested in writing about your company. Support our efforts and help yourself while you're at it.